Hello, Happy New Year. Welcome to 2021. This is your host, Howie, and I'm here to help you win with money in this coming year. Hopefully, you had a great time. I know many of you were looking forward to the end of the previous year. So, this video, I'm going to do something different. I'm going to give you my dashboard. I'm going to go over what I did, track my performance. I'll explain some of it. For some of you who are new to the channels, you may not even seen this before, but I have a dashboard where I track my performance and then I try to adjust what I need to do for the coming year. So please, before we go on, hit the like button, subscribe, and if you have any questions during this video, make sure you comment below and I will try to answer it, or I will make a future video just to answer what you need. What is a dashboard? For most people, it's just a nice pictures and graphics for each KPI, which is a key performance indicator, or it could be anything that you use where you set goals and you track the progress towards the goal. So that's all that is. I create a little dashboard for myself. Most people like things like a green light, yellow light, and a red light. If you work in business, you see that. Some people use some type of progress bar that goes from 0 to 100%. And other people use other ways to do it. But those are the most common ways. What I would like to talk about is what I do. What methods do I use? So when I first started out in the industry, I just started with creating a simple system. How do if I invested $1, I wasn't making much. I worked in New York City, and everybody thinks just because you work in New York City, everybody makes a boatload of money, and that's not true. I started in my 20s making $26,000 working in Manhattan. So the $1 a day method is pretty simple. What you do is you start with really small amounts, like $1. As you progress upwards, you move yourself to a next goal. Can I hit 10 times $1, right? Which is really easy because it's $10. And if you can hit that goal, move yourself to the next bucket to $100. Now, remember, this is $100 a day. You guys know how to do the math, 365 days a year. And if you can get past that, move it up to the next bucket. But in essence, you don't just do this in one bucket. What I started doing was I created a bucket for a 401k plan. Then later I started adding new buckets or new measures. And I'll show you that when we get to the slide. But don't think that this is it is very simple, but it gets really hard. And I'll show you what I mean. Depending on how you track your measures or what bar or what measurement you want to use, hitting $1 a day is really hard. Even hitting $10 a day can be really hard. And overall, what I like to do is I like to measure my financial health. I like to measure it against some of these common ones like cash flow. And then the other ones are not so common. I like to use something like called the NII, is what most accountants use. I use something similar to it. I do something a little bit different, but I'll show you guys that. And a lot of us do measure your debt divided by your asset. And what this is not an income-based measure or system. I don't care if you make $12 an hour, $12,000 a year, or you make $12 million a year. It's not an income base. It doesn't really care. What you want to do is just track it, and the ratios sort of fix those two. That's the beauty of ratios. It doesn't really care what your income is. If you divide one number by the other number, we'll get an answer. So let's move on. Here is my answer for my dashboard. And what does this all mean? Well, the beauty of you watching this is you can hit the pause button. So if I'm moving too fast, you can pause and read it. In the end, I hit my goal. Yay! Basically what this is, I gave you the actual data. I divided up by day, and then this is my dashboard. And each dashboard, you see red is bad. Red generally means 0 or less than $1 a day. $1 a day is this yellow one here, right? Greater than $1. And then greater than $10 a day will be this orange one. And anything above $10, which is $100 a day, will be green, which I don't have. This one is the total result. Okay? And then the last area is, this is my overall health. I'm cash flow positive, so it's green. And then here's my ratios. You see the answer, and then I measure it. I have debt or a little bit of debt, and so it's my numerator, and then everything else is on the denominator. Now, if you have a lot of debt, your number is going to be much higher, and higher is bad, and I'll go through some of that. Here is one of the first ones, 401k plan. I put in $5,700. My employer match gave me $3,000. My balance hit a new all-time high for this account, $52,000. I've been here a few years, and my rate of return is pretty good. The S&P 500 returned 16.71. Last year was 31%, so the standard S&P 500 was 16.71, so I did okay. But I did underperform, so that's the good thing about measuring everything. So I outperformed in this particular portfolio, which is the data here. You see that, the 401k. So my 401k plan hit I put in this much, you divide it up by days, you get this number. My matching surpassed $1 a day. It's almost, if I got $3,650, it would have been a orange here, and it would have been over $10 a day, but I didn't get that. But the good thing about tracking of this is you can see what performed well, what didn't perform well. Overall, when I said this underperformed, because I have other stuff in my portfolio that didn't do so well. And for example, what I mean by that is dividends. For some of you who know, I actually started in a dividend portfolio. I started a while ago. I was a dividend collector for many years, and I still am. And there's another thing called DGI, which is dividend growth investing. And if you use this concept, it is possible to underperform this year. So I looked at my portfolio, and I actually underperformed. So that's a bad thing. And you also have to know why it underperformed. So when I looked at my portfolio, the things that did well were 401k plan. Things that track the S&P 500. Of course, if you're tracking it, you're going to get somewhere near this number. And that's a good thing. In this particular portfolio, I had some small cap and mid caps in here, and that outperformed. But in the things that didn't outperform were things like companies that were doing really poorly, which is dividend cuts. So this year, if you're a dividend collector, you notice some dividend cuts. The other thing is some industries were doing really bad that were historically big dividend payers. Oil, a lot of value stocks were bad this year. Anything that's a REIT took a hit. So if you own like Simon Property Group or some of those other retail investor type businesses, they did poorly. And I'll show you what I mean. In this particular slide, I show the 1 year graph. The market returned this. And I don't know why it's showing only 16% or 15% here. Maybe they subtract fees out of it. I'm not really sure. I would expect 16.71. But here you see the Vanguard high dividend yield underperformed. At the end of the year, it only returned it minus 2% return. And you see that means you're losing 17 points on the spread here, which is a bad thing. And I'm assuming they got hit, or this particular ETF got hit, because of the very thing that I was just telling you. Dividend stocks in general did not do so well. If you own high tech, high growth, Tesla's, Apple, Microsoft, FANG, those did really well. Other stuff, not so well. So this is the beauty about tracking. You can then adjust whatever you need to adjust. So let's explain what those other things mean. Cash flow is probably the most common that a lot of people like to use. And I do like it. I think it's a good starting point. Basically, it means at the end of the month, if you add up all your income from all your sources, work, dividends, whatever it may be, minus all your expenses, your bills, mortgage, rent, car, student loans, cell phone, everything else that has an outgoing expense. At the end of the month, whatever is remaining out of that paycheck or all your income, that number will either be a positive or a negative. If it's negative, it means you're spending more than you make. And in general, that's a bad thing. If the number is positive, it's a good thing. And the last thing about that is the size of the numbers matter too. If you're negative $2,000 a month, you're in trouble. It means you're spending a lot of money. If you're negative 50 bucks a month, that may be different. Maybe there was something weird that happened. Maybe there's a temporary setback. Maybe you're not getting enough overtime hours or something just changed. And on the other hand, it's the opposite. On the other side is the opposite. If you have a huge positive cash flow, $1,000 a month, it means you're making enough money. It means you're not spending everything you make and that you have a lot of room in your budget for emergencies, for last minute things. You want to take a trip. You want to splurge on something. So that's why that measure is very important. The measure of how much cash flow you have at the end of the month. Now the next one here is not so easy to understand. NII, net interest income. Some people say, well, why even do this? And I'll try to explain why I like to do something like this. I'm not going to spend a lot of time on it. You can Google it. You can probably even watch your YouTube videos that help you with really pretty pictures and graphics explaining it. So what I like about this is if you take all the interest you pay out, I'm talking about interest on your mortgage. So if you got a $2,000 mortgage, maybe $1,600 or $1,500 is interest and only $500 is going to principal. Student loans are the same way. Credit cards you can figure out too. You can figure out how much is interest added. If not, you can use an online calculator. Sometimes that will help you. Then what I like to do is determine how much interest you earn in that month. So I'm talking about dividends that you earn. You can earn interest from savings bonds or bond holdings, savings account, checking account. If you're going to include rent from your investment property, you need to include the loan that you use. If you count it here, you got to count it on this side. Now, if you paid off your house or your rental property, then that's awesome, right? Because you have no interest paid out to that particular asset. And so what does that mean? If you add all this number up, most people are sort of in this area. They got this high number. I'm not even talking about debt. This is the amount of interest you are paying out every month. Because if your mortgage is $2,000, and then let's say you got 2 car loans and they're like $400 or $500 for each car, you have a student loan payment of $400 or $500, you got a couple credit cards and whatever it may be. You add all that up, you can have this. And then what this number come from? Well, how many dividends do you get? Maybe you have a 401k plan, and then the dividends on your 401k plan is pretty small because you only have $5,000 or $10,000, so your dividend is pretty small, or how much cash you have in the bank is paying you. And when you do this number, this is what you get. It's a ratio, right? It's 2,300 divided by this is 11.5. On the other hand, let's use another example. Let's say you own 4 or 5 rental properties. So it is possible that you can have a huge amount of interest, $10,000 a month of interest. But if you also add in, remember, if you're including the rent, what if your property, instead of buying 4 houses, what if you got an 8 or 10 or 15 unit apartment or some type of complex? So you correct rent on that. And maybe that wasn't your first property. So you paid 30-40% down, you bought it, owned it for a few years, you're paying it down. What if your numbers are like this? Which is possible. You can have a huge amount of interest you're paying out per month, But your rental income could be, who knows? I'm making numbers up, obviously. You could have $23,000, $24,000. Maybe you got a couple million sitting in the bank earning interest. I don't know what it is. But this is what this is. You can determine what your NII is. And that's what I do. I determine my NII. And same thing here. The last measure I use is grab your total debt. This is not the interest anymore. So if you have debt, just add that up, divide it by your total asset. And this is pretty easy to do. And the reason why you want to do this is the same thing. You want to see, are you on this side where you got way too much debt and very little assets, or are you more on this side, the guy with a little bit of debt, but now you know what? I should have changed these numbers. Whenever you have debt asset, these numbers should have a few more zeros, maybe add some zeros at the end. But you get the point. So when I did my ratio, they're pretty small, and small is good. In fact, if you have no debt, this number should be zero, right? It's a zero on top. And if you have no debt here, your assets could be zero. So that's the way I designed it. I want myself to be I want the ratios to be really good, close to zero. But I also want to make sure you're accumulating assets. And that's the key in this. I mean, the whole purpose of this is not to be like, have zero, but then your asset is like $1, right? Or $5. That's not the purpose. It's to accumulate a lot of assets so that even if you use debt instruments to fund it, the ratios are really low, and that's how this works. Now, some of you may be wondering, am I pulling your leg? How is it so low? And I want to tell you something. I started many years ago avoiding debt. And when I did have debt, I paid it down. Or whenever I bought something, I try to use cash for it. I am a fan of Dave Ramsey for some things. And in this one area, I totally get it. When you have less debt, you can pay down other stuff quicker. Am I totally against it? It all depends. Because if you can buy something with the debt that generates a positive income or cash flow from a rental property, then this is why it's so important to look at it from that context. Debt, when used properly, could help you generate money, especially over time. There is a cost of borrowing, and I never ignored that fact. And most people cannot borrow for $0. You got to borrow from a bank or something like that. Or if you borrow from your insurance policy, there's still an interest cost. There is a cost of borrowing. So what I like to do is never ignore the fact that borrowing money costs something, even if you borrow from your home equity line of credit. But what I like to do is look at how much money does it cost me to borrow versus how much money am I earning on my assets. Because that will give you a good picture of what you're doing. Are you allocating your resources properly? And that's what I do. And because I came from the Dave Ramsey school of thought, I generally have very little debt. Now, I laugh about it because 10 years ago, I had huge amount of debt. $600,000-$700,000 in debt. And it wasn't because I made a lot of money and I didn't pay those things off. I joke about it, but I lost my homes. So you know what happened. When you lose your home, the house is no longer yours. You lose your property. The debt, generally speaking, it gets wiped out, right? My mortgage gets wiped out, and you know, it ruins your credit. And that's what happened. So a lot of my debt magically disappeared because I lost my homes. After that experience, what I did was I wanted to spend a lot of time rebuilding, examining what went right, but more importantly, what went wrong. And it was very obvious to me I owed way too much money. I borrowed way too much money. I couldn't afford all my obligations for all the homes that I purchased. And so when you have a huge mortgage payment, that's due each month. If you can't afford it, you know eventually time is running out and eventually catches up to you. So I learned my lesson. I had to learn to monitor my debt, monitor the cash flow, monitor how much it's costing me, and what am I producing. If the asset didn't produce any income, then you got to be careful. And I'm not totally against real estate. Real estate is a good vehicle to make money, but you got to know your math, you got to know your numbers. So what is the overall summary? Overall, things look really good, but I still want to look at what could be done better. So I told you earlier, my dividend portfolio really underperformed. And so when dividends are being restored or companies start increasing dividends again, banks are starting to pay dividends again, that will help. But there's still something I need to pay attention to. Not all companies that I have, maybe were not as strong as I thought. And what if some of these value stocks were really a value trap? They're stocks that really never move up, and last year they moved down. And so these are things you want to examine, or at least I want to examine in my own portfolio. Should I sell some of my losers or things that are not really good value and move it into a growth company? The other thing is my option trading does make up some of the difference of the underperformance. For this particular video, I didn't add in how it impacts my gains or losses relative to the market. I wanted my comparison to be relatively straightforward. So that's how I came to the conclusion of, yes, I underperformed the 16.7% rate of return on average, right? That's what I did. I look at my portfolio and look at what the change of value was. And if I underperformed it, I underperformed, but I need to know why. Lastly, there are some things that did continue to do really well. I will continue to keep on adding a little bit of Bitcoin into my portfolio. It's really small. I don't do a lot. You saw the numbers. It was $600, whatever it is. I normally dollar cost average into it. Sometimes I do $20 a month. It's not a lot. I'm trying to get into the habit of buy it every month, buy a little bit. You don't care if it goes up. You don't care if it goes down. You don't care if it goes to zero. Obviously, when it goes to zero, you care because you basically lost everything you put in. But this is why I dollar cost average using $20 or $30. Use a small amount that you could afford to lose. The other thing I want to look at, I need to look at transferring more risk. And I'm talking about using non-correlated asset class. So if you have all your eggs in one basket and if the stock market tanks, you could be in trouble. So one of the things that you want to do is also look at your portfolio or look at your net worth. If everything is tied into just one asset class, that could be a danger. We all know what happened with Enron. While people were making money, everybody was happy. They started loading up. They put in all their money they can in a 401k plan into Enron. And then when that company turned out to be a joke or a fraud, people lost their life savings. So part of what you want to do is look into transferring risk. And this year, I'm definitely going to spend a lot more time addressing some of those challenges and how you can reduce some of the risk using insurance products. With that being said, I just want to step back, reassess, and I'll do these dashboard once a year. Please, if you have any questions, please comment below. But also for you, I want you to have some type of measure or dashboard for yourself. The only way you know where your finances are is if you take a measure, you assess it, you take a look at it. How are you doing? Are there a way for you to measure how well you're doing? Because if so, then you're doing better, or at least you could do better. It is just like the oven. The temperature in the oven, if you don't know what temperature it is, you can overcook it or undercook it. I'm just always trying to gauge where I'm at to figure out what I need to do, what type of adjustments I need to do. So please, thank you so much for watching. Stay tuned. This year, I do plan to do a lot more training and teaching videos to help many of you guys to be a better investor. So that ends my first video of the year. So let's do this together. Let's do this $1 at a time. As always, have a profitable day.